In March 2021, I walked onto the trading floor where I worked, and the energy was different. People were on their screens and nobody was talking the normal way they usually would. The headlines were rolling out. One hedge fund called Archegos Capital had collapsed, and investment banks had exposure to that hedge fund. Other companies like Credit Suisse and Nomura Capital had a larger exposure. The hedge fund Archegos Capital was a family office. They had built a huge, enormous position in a handful of stocks, and they had used something called total return swaps, which is using loans from banks to invest. Most hedge funds use this strategy to multiply their gains, but their losses as well had similar multiples, which exposed these investment banks to these risks. The positions were so large that when forced selling happened, there was no orderly exit, it was carnage. I sat there watching everything unfold. And I said to myself, this is what happens when you combine every single risk factor that professional investors spend their career trying to avoid. I'm going to explain what those risk factors are, and I'm going to open your eyes to something that will make you a little uncomfortable. The owner of Archegos Capital was not an amateur, he was a sophisticated investor. He built a structure that combined 5 risk exposures that I'm going to explain to you because understanding them will matter to you personally. The first risk factor was leverage. I'll use an example. When you want to buy an asset and the asset is £100,000, you can buy the asset outright with £100,000 in your bank account. If the asset goes up 10%, you make £10,000 on your £100,000 investment. If the asset goes down by 10%, you lose 10,000 and your money left is 90,000. But when using leverage, this is how the numbers will look like. Leverage is borrowing money to add to your money to invest in that asset. Most hedge funds will do this through a total return swap. They bring 10,000 and borrow 90,000 from the bank. Now, when the asset goes up 10%, the value of the assets will now be 110,000. They only brought 10,000, but they have made additional 10,000 by using a total return swap or leverage. In this case, their 10,000 investment from their own pocket has gone up 100% instead of just 10%. But guess what? If that asset that they've bought loses 10%, they lose all their investment. They don't lose 10% of their investment. A second risk profile I'm going to explain is something called concentration. Archegos investment was not spread across about 100 companies. They were concentrated in a handful of companies. Companies like Viacom and Discovery, and a few Chinese technology names. Concentration is one thing that destroys portfolios because if that thing or those few things you've invested in lose their value, that's all your money gone. This is why the argument of investing in global ETFs is quite strong and being pushed hard nowadays in the personal finance space, because betting on one or few assets could lead to significant losses of your money. A third risk profile I'll describe is something called correlated risk. The stocks that Archegos held did not move independently of each other. They were highly correlated, meaning if that industry was losing money, all the stocks in there performed similarly. Archegos therefore had no cushion. When the tide turned, everything turned in one direction. Sophisticated investors, on the other hand, hold assets that behave differently of each other. For instance, taking on risk assets like buying stocks. You can also get some gold exposure or bond exposure to help reduce the impact when the stocks are underperforming. The fourth risk consideration is liquidity. Because Archegos used complex derivatives rather than just shareholder ownership, unwinding the positions when he needed to act quickly was not that simple. The moment things went wrong, the complexity made it difficult to exit cleanly and quickly. Liquidity is freedom. When liquidity disappears in a crisis, you are trapped. Money that could be available to you is stuck in an asset, and you may not be able to control the value of that asset, which will affect how much you can make back. The last risk consideration I want to talk about is something called forced selling. This one is what actually destroyed Archegos. So when the banks that had lent money to Archegos started noticing what was going on, they started making margin calls, which caused Archegos to sell because the company could not provide more collateral to cushion the losses that they were seeing in the positions that Archegos had taken. I watched this happen on my screen on that day, and I said to myself, this is how fragility looks like when it actually collapses. When you combine all these risk considerations and the foundation gets a bit shaky, collapse is really catastrophic. Now I want to pause here and show you something that you need to know. When I describe what happened with Archegos, everybody thinks, oh, they were a bit careless, oh, they put on too much leverage, they gambled with so much money and they deserved what happened to them. But what if I told you the structure in which you've bought your property, your home that you live in, has very similar risk considerations? Let me walk you through the 5 risk considerations again. Leverage. Most people will put down 5 to 25% of the value of their home and borrow 75 to 95% of the value of that home. That is high leverage. If a hedge fund did exactly that, the regulations and the banks would be ringing alarm bells as to how risky that hedge fund is. But when a household does it, the society calls it getting on the property ladder. Responsible, something to aspire to. The leverage here is very identical to what the hedge fund did. The social story around it is completely different. Number 2, concentration. Most people who own homes in the UK have majority of their net worth tied to one building, one postcode, one area, and one local economy. That is the simple definition of concentration. If your net worth is £100,000 and £70,000 of that is in the property you own, that is a highly concentrated portfolio. Professional investors call that concentration risk, meaning if that particular asset comes down, the effect on your portfolio is catastrophic. But because it's property, it's physical, it's social, it's highly celebrated as an achievement, most people don't look at it this way. The third risk consideration that we looked at that I want to compare to your property is something called correlated risk. Think about it. If your job is in London, your income depends on London. If your home is in London, your wealth depends on London. If your business serves London, your revenue depends on London. If you own a buy-to-let in London, your rental income depends on London. One economic downturn, one crisis, one country or area risk is how your assets are fully exposed to London, and therefore your assets are highly correlated to a particular area or space. Most households have accidentally built a highly concentrated portfolio because majority of their net worth is tied to one property. The next risk consideration is illiquidity. I don't need to talk about this much when it comes to property. When it comes to time to sell your property or when you need money from your property, it is not as simple as selling 8% of your kitchen or selling 10% of your bedroom. Selling a property takes months, even sometimes years, to be able to liquidate that asset. Compared to owning shares in different companies, where you can buy and sell easily on the stock market, even if the price has fallen, you can still get some liquidity out of that particular asset without waiting too long or going through too much of a hassle. As they say, cash is king, and if liquidity is tough for you with the asset that you are most concentrated in, that is a risk. The last risk profile or consideration that I need to open your eyes to when it comes to your property is something called forced selling. This is not because property is a bad asset, but when life forces you to sell at the wrong time in the wrong season because of a divorce, a job loss, interest rate shocks, and illness, and if that particular asset, which is your property, is leveraged, meaning you've used a loan to buy it, it becomes too much of a stretch if you need to absorb a lot of financial shocks with this particular exposure. I want to be completely clear about something. Before I move to the part where I talk about solutions, this is not a video to tell you that property is bad. I own property, and property helps people to build serious wealth. I just need you to understand how to look at the property you own or the property you're looking to buy so that you can put in place the right things that can help you reduce the risk you have towards property. Before I move on to solutions, let's talk about this. Back home, everybody saw property as something to aspire to. The good thing there was that most people will buy land and build their property slowly and gradually. In this case, money is directed into the property gradually. That is not all the money you've saved in the world. But when I moved to the UK, the dynamics were significantly different. The property already exists, and people will take a loan and hope and pray that the rest of their lives they will be able to work to pay off the loan for over 25 to 30 years. The risk profile of property then has significantly shifted from an asset that you gradually built over a period of time and is completely yours to an asset that is pretty much owned by the bank that you are paying off for most of the rest of your life. If you buy your first property at 30 and you have a 30-year mortgage, that means you are going to finish paying off that property at 60. Throughout that whole time, the bank is a lender. The bank owns majority of the property and you are working hard to pay that off. With that in mind, let's move on to things you can do to help you reduce this risk profile that I've shared as a property owner. 1. Leverage. Reducing your leverage is one of the best ways to protect yourself in property ownership. One of the ways is to save up a higher deposit before you decide to commit to a property. The economy is tough and people are finding it very hard to save money and therefore think it's better to get on the property ladder with a high percentage of the property in loans rather than their down payment. But putting a bigger deposit down and owning a bigger percentage of a property would reduce your risk significantly compared to somebody who has put down about 5% of the property and has loaned 95% of the asset that they are purchasing. The other way you can think about leverage is reducing your exposure to the bank by paying down the property faster than what the contractual agreement is. This comes when you overpay your mortgage. The bank usually has a limit to how much you can overpay your mortgage by, but it's advisable to find a way to pay down more than what you are contractually allowed to pay to help reduce the loan you have on your property. The second strategy to help you reduce your risk as a property owner is diversification. I know I just talked about overpaying your mortgage as a way to reduce your risk as a property owner. But that strategy of reducing your risk needs to be balanced. If you keep putting all the extra money you make in your property, you still have concentration risk. Therefore, you need to think about how can I balance my portfolio or net worth with other assets rather than just the property that I own. This is why I keep talking about investing and investing in global ETF or ETF that have exposure to not just one sector or country. Because having assets that have different behaviors and different profiles can help you withstand risks that could appear depending on what is happening in your economy. So if you have £500 at the end of the month that you can put in your property and in assets, you can split it down in half. £250 goes to overpay your mortgage and £250 goes to invest in the stock market. The other way you can think about it as a property investor is investing in real estate investment trusts. I have done a full breakdown on my website on how to look at real estate investment trusts and how to invest in them. I will link it in the description so you can have access to it if you want to check it out. But real estate investment trust is one of the easiest ways to own property and not have all the exposure to one particular property that you live in. This helps reduce the concentration risk from just the property you live in maybe London, to properties maybe global, maybe in the UK, maybe outside of the UK, and does not concentrate it in one particular area. The third way you can protect yourself from property risk is building liquidity. Liquidity is indirectly cash. And we all know it takes a while to sell property, even if you are able to sell it the moment you go to market. Therefore, emergency fund or a buffer is highly important when you're considering buying your first property. Most people will save their deposit and quickly use that to buy a house when their affordability reaches, without thinking of putting down an emergency fund when it becomes necessary. The other way to protect yourself when it comes to liquidity is insurance. There is contents insurance, buildings insurance, life insurance. And mortgage protection insurance. These are all types of insurance you can consider. I know when insurance comes up, most people think you just pay premiums and you will never use it. But when it comes to something as risky as owning a property that is highly leveraged and also dependent on your income, these insurance policies can become very valuable when you need it. Now let's look at correlated risk. If your job, your home, your revenue, your pension is all concentrated in a particular area, London, England, UK, you have exposure to this risk. It's advisable to hold assets from different geographies, and you can get this exposure easily through the stock market. The last thing I'll say is to build multiple streams of income. Most people's mortgage affordability is tied to their income, their day job. It's best to look for other means of income when things are stable. Last week, I talked about ways to make income from the property you already live in to help you pay off your property faster or give you a cushion when you need it. I'm going to link that video somewhere here and put it in the description so you can check it out and know how you can generate income from a property that you already own. I would like to challenge you. Ask the right questions. Before you buy your first home, don't focus on how much the bank will lend you. Ask questions like, what level of financial commitment leaves me resilient? And answering those questions honestly can help you decide how to commit yourself to a long-term pricey asset like a property that you live in. I walked off that trading floor on that day and I learned a hard lesson. A lesson that I hadn't applied myself. Now I am working actively to make sure that my resilience towards my property is high. And I'm sharing this with everyone who cares about their money, their net worth, and how to make smarter money decisions. If you like this video, you would also like the video I posted last week on how to make extra money from your property. Share this with anyone who finds this helpful and subscribe to my channel for more videos like this. It's been Abigail. Catch you next week.